Venugopal Garre, Managing Director at Bernstein, joining in on the show right now. Venu, hi, good morning. Great to have you on ET Now. Venu, just scratching our head and wondering what's changed for the FIIs from March 29 to now. I mean, month to date, I was just looking at the numbers. They've been buyers and by a decent quantum.
Yeah, thanks a lot for having me on the show. Honestly, I'm not surprised. I probably am happy to say that because I think it was pretty much anticipated that there would be a reversal in terms of flows, in terms of positive flows from an FI perspective. And believe me, it's like I think to a large extent, while India might have seen that return, which is basically India has outperformed most of the emerging markets in the month of April, but the reality is that to a large extent we're also seeing some flows shifting to EMs from DMs. So it's like, broadly a global theme. I would probably argue that, when we ourselves looked at the possibility of that, it was in the fag end of March is when we started thinking about the possibility of a rebound led by flows. And when early April, when we upgraded, I would probably upgrade. The word upgrade is basically primarily to represent the fact that we were looking, that the Indian markets or Nifty should head towards the 18,500 levels from the 17,000 levels we were. Part of that was also driven by the view that we were seeing macro bottoming, which is a very important variable for foreign investors. And the second thing is current account, which was sort of flattening, from a deficit to marginal surplus, I would probably say, which is a possibility for the March quarter, which means that you're going to see a currency stability, right? And this is something which is more or less common for most of the EM currencies as well. So that's broadly what you're seeing at this juncture. It's not really an India-specific trade, but India has been a fairly important part of EM in driving this trade.
And Venu, since you're in India, we would have loved to host you in the studio as well, but maybe next time since you've already moved out of Mumbai to Bangalore. But I wanted to talk about financials as well. What's your take with respect to that? Because this entire moderation of credit growth, peaking of NIMs, etc., has been much talked about.
No, I agree with you. See, it's always that, broader thinking about, what was it last year, and compared to what it is this year. See, but the reality is that financial sector is, weights, or rather the contribution to the index will eventually continue to improve through the year because there is still certainty in terms of growth. And number two is certainty in terms of, their asset quality. Now, this is very, very different from what it would have been even 2 years back or 5 years back. I guess that will probably bring in a return of interest in financial sector as well. Within the broader construct of credit growth, sort of being, let's say, in the 12-13% range, broadly from a system point of view for this year, lower than what it was at the fag end of the previous year. And more importantly, of course, NIM speaking and potentially seeing some correction. All that construct yet, I think there is still room for, financial sector to sort of deliver positive returns this year.
Venu, just on interest rates, because you just alluded to that in your first answer, wanted to understand, A, what are you thinking about how the RBI trajectory is going to be? And B, looking at the CPI print in the US last night must be a bit of a relief because it seems like the Fed for surely is going to head in for a pause and then eventually a rate cut.
Yeah, so I guess it was largely anticipated. Inflation, moderation, directionally, I guess if you look at even relative to consensus, it was like 5% versus 4.9, which was delivered. So to that extent, I don't think it's like a material surprise. But the reality is that if you were to look at the absolute number itself, I guess it's still fairly high compared to the medium to long-term trajectory which the Fed would possibly be more comfortable with. And more importantly, since the economy still looks okay at this juncture, tightness in, the labor market and other things, which I guess I would be still very skeptical about the potential for a rate cut happening later this year. I'm in the camp that probably you should continue to see rates at the current levels, which is pause is a very likely possibility in the next meeting, and thereafter perhaps pause will be sort of the theme for a while. And the reason for that simply is that if you were to do a premature rate cut cycle, I guess there's a risk that you would start seeing inflation coming back again. And I think that's going to be very, again, a very tough thing to manage. Remember, we've had 10 years of, sort of major easing that we have seen in the economy. It's not very easy to break that economy down as well in terms to slow it down. So I would not be in the rate cut camp as yet. If it happens, then I'm, of course, going to be very pleased.
In light of the kind of global demand setting that we have, what's your outlook on the commodity space?
See, at this juncture, if I were to broadly put this in terms of my thinking around how I'm looking at demand and the rate cycle, since I'm not looking for rate cuts to happen, my view is that there's still room for commodities to fall. So across the board, even the commodities which people buy from a risk off perspective, I think it's like there's a risk that it should potentially moderate. Now, which in theory means that even for a market like India, further commodity moderations is of course an incremental positive, which is not perhaps priced in, because I don't think people are expecting crude, for example, to fall, let's say 15% from here. That's not even like in a base case for any for anyone, including us at this juncture. So we have assumed flat line, but there is a potential possibility, of moderation for commodities.
Okay, Venu, also wanted your take, since you're saying that you were not surprised by FII flows coming back to India, but your Nifty target still continues to be around 18,500, which is not too far away from the current levels. Are you looking at upgrading it at any point of time?
That's a very interesting question, but I'll probably highlight it in a different perspective. That by the way, this is not just FIIs. You just see domestic flows as well, right? In terms of what they're getting through SIPs, that's also very, very strong. So there'll be a stage where there'll be capitulation because cash levels can't really go up a lot. So you have to invest in the market, even if it means broad-based market seeing a much larger return than the Nifty itself, right? So that's a potential possibility. The second thing is, I personally think that holding up at this level, going up to 18,500 itself is a very interesting call, because once it crossed 18,000, there was this potential pressure that, hey, it's going to probably correct back to 17,000. I'm of the view that it'll probably hold up, and you could probably see some positive surprises in terms of overshooting, which is the call right now. We haven't really thought about upgrading it to something like 19 or 20,000, because I guess we still need some more information about things like how monsoons are going to shape up. Consumption is still, sort of sluggish. Earnings growth, I guess, will hold up, but is there room for upgrades? So, and valuations, of course, have, sort of inched back now to 20x 1 year forward. So all of this sort of restricts my bullishness in terms of wanting to upgrade, but then I think it's going to hold up for a while.
Time you wait for those data points, Venu. What are the house overweight, underweight calls?
Yeah, I mean, we per se have overweight on financials, the largest sector. We have a marginal overweight on IT, and I think a lot of times these Fed rate peaks, historically we have seen that, also leads to some return of interest in IT, given the underperformance that they've had. It's a mild overweight that we have. So that's the second one. Apart from that, within industrials, you've got cement as an overweight, largely to play volume growth rather than, and this is more to play real estate cycle as well, where I've generally been very positive, and I think it's going to be positive for a while, a couple of years. So these would probably be the main overweights. We are underweight on industrials, and that's like something which we did after 2 years of being overweight. It's not like a historic underweight. I mean, just look at where industrial sector beyond L&T is in terms of valuations. Despite the positive momentum both in margins and orders, I think it's going to be very tricky to sustain those valuations. So we are underweight that. We are broadly underweight consumption, as I mentioned, amongst the two, the other two sectors.
Vinu, are there any particular risks that you believe that maybe the global financial markets aren't, taking cognizance of at the current juncture?
I guess we just need to watch commodities and anything else, because that's something which is still unpredictable. Something happens to commodities, we probably, need to worry about. Number two is, look, there has been this school of thought that we should really worry about US banking system and what could that mean for systemic risk globally. But until now, I think it's been fairly managed well, even if these weekend affairs, with it to try to manage these bank consolidation events. But that's an area where I guess globally people are watching more closely than I have been. But I guess that's important. We don't really want a systemic shock, right? The so-called hard landing word which people use. So that's an aspect.
You're underweight when it comes to the consumption, but what about the entire manufacturing theme? Because that seems to be the sunrise sector per se. And also your view on pharma?
Yeah, so I would probably say manufacturing theme to a large extent. Manufacturing GVA from negative potentially could see a positive trajectory this year. And that's a part and parcel of the way we build GDP growth as well, right? In terms of acceleration. But I don't think this China plus one in manufacturing is really a near-term driver or even a medium-term driver. This is a fairly long-term driver. So it doesn't really impact markets much. That's broadly the view. On healthcare, we are it's a smaller sector, so we typically take it bottom up, and that's why I never call it as an overweight or underweight. But yeah, we're marginally overweight that as well at this juncture, but we're taking stock by stock calls. That's the way I would look at it, and that's underperformed quite a bit, in the last 2 years as well, especially last year. So there could be opportunities, but remember, it has to be bottom up. I think it's very hard to take a top down synchronous call in healthcare at this juncture, especially I'm talking about the pharma names.
Color that you can give, whether it's diagnostic place one should look at? Are you more positive on hospitals? Is it more tilting towards manufacturing, and that to domestic facing or US facing?
See, domestic facing, of course, there's always this positivity, and I guess that's an area where we still need to be positive on. The other two areas you mentioned, hospitals and diagnostics, look, those are more secular growth stories. So I guess there's nothing to it this year, even though we don't really have coverage on those names. So no specific allocations that we've done to that.
Right. Okay, Venu, great to have you on the show. And next time, hope you can make it to our studios whenever you're in the country.
Sure.
Okay, that's the word coming in from Venugopal Garre of Bernstein saying, look out for commodities. That's the key moving part.